Hello and welcome to the CNBC-TV18's Mumbai newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh. You're watching MF Corner. And today we do a deep dive into selecting the right mutual fund for our viewers. We'll also touch upon various ways an investor can start their investment journey with mutual funds and what a particular category they should be going on for. So Pavitra, it's going to be a classroom for new investors and for the existing ones as well.
Oh, absolutely. And we could always use a refresher, right, on how to really go about investing, especially when you're starting off. So let me welcome our guest on the show today. We have Kalpen Parekh, Managing Director and CEO at DSP Mutual Fund, joining us on the show now. Kalpen, thanks a lot for joining us. This is Pavitra. So, we get this question very often, how do I pick the best mutual fund? Now, while I understand that there is no one best, there is no one-size-fits-all approach, take us through how you look at, different asset classes at different times. For example, do you think right now it is a good time to be looking at equities, taking exposure via equity mutual funds?
You started off with the most difficult question. In fact, just a couple of weeks back, we did a campaign. It was a hoarding campaign on education where we said that till you find the best performing mutual fund, start with index funds. Because, new investors who are very new to the category, who don't even really know how to, understand the nuances of various funds, various managers and their styles, they end up actually doing injustice to their money by always picking up the highest return fund in the last 1 year, which most often in the next 1 or 3 years does not remain the highest return fund. So, which is why we always say that, if you are a new investor to investing to mutual funds, start first with an index fund or start first of all, identifying a good advisor who can build the portfolio for you. But assuming you want to still do it on your own, start with an index fund. Next step could be a flexi cap fund, which is about, the right companies the fund manager will select. You don't have to really worry about which market cap to go in and so on and so forth. And the third option would be a hybrid fund, which has a combination of equities and bonds, because there are phases of markets when equities don't do well for 2, 3, 4 years. And at that point in time, some component of bonds in the portfolio is always advisable.
Yeah, actually, recency bias always works with investors who are new to the market. So that's exactly what they need to avoid as well. Well, you spoke about certain ways in which they can invest, right? Start with an index fund, then go for flexi cap and hybrid. But do you think it's equities which they should be looking at generally right now? I'm sure you get this question as well a lot. What are you looking at the market right now, currently at these juncture that we are in, mid caps at record highs, blue chips not doing so well? What's your take?
See, my preference always after, spending so many years is the first belief I have is that everything mean reverts. This too shall pass. So what is doing very well may not do very well in the next 2 years, and what is not doing very well may start doing very well. So I don't get carried away with near-term movements of large cap, mid cap, small cap. It's part of the game. But I think the fundamental thing is that in the long run, equities always meet inflation. So that is a very fundamental long-term truth. So any investor who wants to come for wealth creation and has 10 years and above money should start with an equity fund, notwithstanding how markets are doing right now. And if you're slightly, worried or slightly cautious investor, and, many investors who are new to investing, let's say they invest and suddenly markets fall by 15%. Every year, anyways, markets fall by 15%, come what may. He should not panic and say that, okay, my money is lost, let me get out. And he'll never come back to equity. So normally for a first timer, I would say that start with an SIP in equity, or start a lump sum investment with a hybrid fund, which has 70 rupees in equities and 30 rupees in bonds. So even if markets were to correct, there is some cushion. And more so right now when markets are not cheap, they are already, trading at reasonably rich valuations. It's better to, have a hybrid fund in the portfolio. And hybrid includes 2 buckets. I think it's showing on your screen. It's hybrid as well as multi-asset. Because right now markets are slightly on the higher side.
Okay, got that. That actually leads me to my next question, that when you're investing in mutual funds, specifically for first-timers, how important is it to consider valuations? Say you're looking at a very long-term kind of investment. Yes, you could wait for that 10% correction on the market, but that is very difficult to time. So what would you suggest? And also, how are you looking at valuations currently across the board for the various market caps?
See, the fact that we have, very shortly in the next 48 hours, we are launching a multi-asset fund is in a way an indication that, we prefer having more asset classes than only equity. And, that is a reflection of our view that markets are running a bit ahead. They are maybe 1 year ahead of what their prices should be. Valuations are rich right now. We do feel so. And hence the need for multi-asset or hybrid investing. But If this is a first-time investor who has 10, 20, 30 years sort of money to invest, he anyways has zero equity exposure in his portfolio, then he should not worry about valuations. He should not get confused with anything that I say. He should start with an SIP in an equity fund and build it forward. But the time horizon should be long, and the recognition that intermittently NAVs will fluctuate, markets will go up and down, that acceptance should be there by the investor. So that if that awareness is there, then you don't panic at the wrong time and get out. See, ultimately, we just don't want investors to come in and invest with us. We don't want them to stay for long with us and stay for 10, 20, 30 years.
Okay. So that, of course, explains what the strategy would be for any investor who's investing maybe for the first time or for a long haul as well. When you are looking at investing in debt funds, because that's been a debated category for the longest time after this cap gains or indexation benefit being taken away. Adli, what is the kind of time frame would you suggest here? There are many cycles in the middle. So is a long-term approach good here, or do you think in the middle investors can see the profits and, see some redemptions?
So, Sonal, the challenge is that, we're talking of first-time investors who don't even know how to choose a fund. So I don't know how to even explain to them what can be these intermittent cycles of fixed income, monetary cycle, fiscal cycle, and so on and so forth. So from a simplicity point of view, and I'll tell you what I have followed over 25 years, is at large, my investments are in actively managed short-term funds. They normally, own bonds from 1, 2, 3, 4 years sort of maturity. So they don't have too much of interest rate risk. And normally in India, the yield curve is, more or less flat after 4 years. So the yields on a 4-year bond or a 10-year bond are more or less the same. So that is my behavior at large. At extremes means, once in 7-8 years when interest rates rise very sharply, our inflation is high, currency is falling, Reserve Bank comes and hikes rates, and bond yields, 10-year GSEC goes to 8% or 9%. Only then will I go and invest in a long duration dynamic bond fund. But otherwise, my preferred product is a short-term fund, because the investor does not yet understand, who is first-timer, what can be fluctuations. And which is why it should also be defined basis the time horizon of that investor. So longer the time horizon, you can experiment with funds which have higher volatility and have the potential to generate that extra return by taking that volatility. So for a first-timer, I would say, stick to an actively managed short-term fund.
Okay, got that. Since we are talking about the debt space, are mutual funds looking at the debt fund category differently now that, we did get that tax change come through, the indexation benefit is taken away as well. So how are you as a house looking at debt funds? And have you also seen a very big move to, arbitrage hybrid funds as well?
So we do see, so there are two types of investors. There are some who, by mandate cannot do anything in equity. They continue to invest in debt funds, whether it is money market funds. We do see recently interest in our actively managed dynamic bond fund, because there we actively take interest rates views. For example, in the month of March, when bond yields had gone to 755, 760, we had taken our portfolio duration to around 8 or 9 years. And then when rates came down to 695, we took some profits out and we brought the duration down to 4 years. So we actively keep managing that. And these are times when after 3-4 years, we are getting attractive interest rates, attractive real rates over inflation. So some set of investors are investing in those buckets. Those investors who have a choice to also invest in equity. In the past, what they were doing is, let's say they were doing, 60 rupees in equity separately and 40 rupees in bonds separately, and running them independently. Now they are blending it via hybrid funds. So products like our equity and bond fund, which is a 70-30 mix, 70 equity and 30 bonds, they are more tax efficient. So, one increasing trend we've seen since the last 3-4 months is there is a gradual increase towards hybrid funds, either in the equity and bond category or the dynamic asset allocation category or the equity savings fund category. We have seen increased interest for better. So because that component makes the underlying debt portfolio also far more tax efficient. And secondly, what happens is that, what's happening, see, in the last 1 year, last 9 months, 6 months, stocks have moved up between 15% to 30%. Now, if you want to change your asset allocation, you will trim from equity, move to debt. You will pay tax. Then when you want to move back from debt to equity, again, there is tax and cost incidence. So hybrid funds are very appropriate because the rebalancing happens automatically beyond our manual intervention, and tax efficiency is also very high.
Okay, so that's why hybrid asset allocation makes sense in certain cases, and the measures that you mentioned as well. Now, since you spoke about some stocks moving higher by 5 to 15% in the last couple of months, I have to ask you about small and mid caps. You said it doesn't really matter so much, but there has been a massive rally here. Today itself, mid cap index is above that 40,000 mark. Would you suggest this to the clients? Still a right time to enter these two spaces or schemes which cater just to small caps and mid caps?
So, first-time investor, again, if he's coming via SIP for very long periods of time, see, in an SIP, let me explain why in an SIP current valuations, whether high or low, don't matter, is because if I am doing a 10-year SIP, I will have 120 installments. So my money which is coming in this month's installment is only 1 divided by 120. It's less than 1%. So current valuations almost are irrelevant because my investments are going to happen over the next 10 years. And hence, for an SIP investor, valuations actually don't matter because, you're constantly coming across different market cycles. And good small and mid caps are absolutely fine. Let me also highlight another point. If you do an analysis of stocks which have lost maximum wealth in the last decade, where they have fallen by 60, 70, 80%, either because of business model issues, governance issues, these stocks corrected sharply, they have very high number of shareholders, retail shareholders, 15 lakh, 20 lakh, 40 lakh. Some of them have 45, 50 lakh shareholders. And these were not necessarily great companies in the first place at all. These companies did not even have double-digit ROEs. So instead of investors going and, punting in small cap stocks without doing their homework and buying stocks which don't have fundamental quality, they are far better off being in a small cap fund. Let me give another example. If you had invested in a small cap index in the last bubble, 2007, Jan 2007, since that day till today, 16 years have passed. The small cap index has earned only 8% return, which is just same as the bond yield. But small cap funds, whether DSP or most other small cap funds in the industry, because they ensure that they screen out the bad quality small caps, they've delivered between 14 to 16% CAGR. So that is the beauty of, small cap and mid cap fund. I would always encourage investors to start investing through small and mid cap funds before they go into small and mid cap stocks, unless they are experts and they know how to choose funds.
Okay, very interesting. Since we're talking about this, I'm just going to throw in an extra question. What do you think of the micro-cap fund and specifically going passive in a micro-cap fund? Do you think that is a good approach or do you think it should be only active?
Personally, so we have done our data crunching, maybe in the next 2-3 months we will launch. So the micro-cap category, I think, doesn't exist now. It's only the small cap category, right? The micro-cap category got converted into small cap a couple of years back. So in small cap, we strongly believe that elimination of stocks is very important. Probably around 70 to 80% small cap stocks in their lifetime remain small caps or they actually become micro caps. They don't survive or they don't really grow. It is only between 10 to 20% which really emerge and grow. So inherent risk of accidents in small caps or mid caps or micro caps is very high. And the companies which are prone to accidents are the poor quality companies. And when you buy the whole index, you're actually buying even the poor quality companies. So when we launch our small cap index fund in the next couple of months, it will actually be screened for quality. It will actually be a small cap index with quality as a factor and not the entire index. So from the entire index, almost 67% companies will be eliminated and only the balance 1/3 will be there. So we are believers that in the small and mid cap bucket, eliminating poor quality stocks is very important and not, just blindly buying the index. Though right now my view is actually extremely wrong because the index is doing far better than actively managed small and mid cap funds.
When, we also don't know why some of the stocks are rallying the way they are, right? So the point of quality being a big parameter for selecting stocks in that fund, totally taken. But Kalpen, we do have a lot more questions, but we'll slip into a quick break. And on the other side, we'll continue this interesting chat with you.
Welcome back. You're still tuned into MF Corner here on CNBC-TV18 and we still have Kalpen Parekh of DSP Mutual Fund with us to talk all about creating a portfolio, how you should go about allocating as well. Kalpen, one question that we get a lot and, is A, how do you pick between active and passive? Are there certain categories where active is just the way to go or passive is just the way to go? And also, how should you pick between index funds and ETFs? In India, it's very different from the States, right? Where, for example, ETFs will give you that tax benefit. Over here, that isn't the case at all. So what would you say on both of these?
Sure. So, as an investor, like I said, you need to be really discerning and you need to have the right nuance of understanding a fund, its style, where is that style in the cycle right now. You should have the ability to acknowledge or accept the performance cycles of an active fund. So let me explain. A passive fund will give you broadly the return of the market. It will help you meet the market. It will never help you beat the market. Now, if you want to earn higher returns than benchmark, you have to go to active. But in that, there is a chance in temporarily, because of a cycle not in favor with the preferred portfolio of the fund manager, your active fund could also underperform. And if as an investor, you are not able to live through those cycles, then active funds are not for you. You better be with passive funds, where at least you'll meet the index. But on the other hand, if you have learned how to, mix and match different styles of portfolio managers or, schemes, and you know how to pick the right one at the right time, then there is a very wide choice available in active funds. So I would say that evolved investors should look for active funds, those who are very new, those who still don't know how to choose funds, who have a lot of these basic questions in mind, they should first prefer a passive fund. Now, within passive, you rightly said, India doesn't have extra tax advantages for ETFs. So index funds are actually far more simpler. You don't need to open a broking account to buy an ETF. Even without a broking account, you can go and buy an index fund and get the same exposure to the same passive benchmark. So start with index. If you have a broking account, you can go to ETFs. And as you learn styles and, become a better investor yourself, then you can think about active funds.
Okay. Kalpen, this is the ongoing active versus passive debate, but let's switch on to the other topic, because I was hearing your comments earlier. You'd spoken about how risk-free communication needs to be made entertaining, because now mutual funds are still 10% of the savings. And the way influencer community is doing it, making it more entertaining when it comes to giving that financial knowledge out. But things have changed since then. Now, SEBI has come out with rules for this community. There are more restrictions here. First, what do you make of it? And second, how do you think mutual funds should change the way of communication to bring in more investments or more awareness about this asset class?
So I wish I had an answer, because if I did, I would have already achieved the game.
No, of course you have, but still, we talk about the larger picture.
So I think, communication should be relatable. It should be, in context to the life of the consumer. If the consumer, and there are different consumer personas. So I think what we need to learn as a fund house, I'm not talking about the industry right now, I'm just talking about us, is to, understand the persona of each of our customer pools, and then try to talk to them around their needs, their context, and their life. So that is one way of, becoming relatable to them. But having said that, that necessarily does not make them intelligent. That necessarily does not make the customer more insightful about how to learn about markets. So today when we, publish our Netra report or transcript or Converse, where we actually answer some of the questions you ask us on television about which sectors, which market caps, what about valuation. Unfortunately, we can't make it too interesting, because we also have to, cover a lot of data and charts. So while we keep attempting it, I think the right overlap is communication should be honest and authentic, because that's our responsibility and duty. Second, it should be relevant, contextual, and insightful, because that will help the consumer learn and become better. And lastly, it should also be entertaining, so that we can, hook their attention in today's world, where virtually everything is vying for our attention minute to minute. So if we are able to get all three together, so we've made attempts, like, we used stand-up comedians and humor to explain very complex concepts like don't chase past performance, don't be trapped with recency bias. So we created some 8 or 9 series, like a series of stand-up comedy, videos to highlight that. So I think the industry is also, trying to simplify its way of communicating. Mutual Fund Sahi was the first, simplest, most, line ever in the industry of fund management in the world to, at least start making the idea relatable. But I think a long way to go. And secondly, what happens is that investors like always the good side of the coin, or we tend to over-communicate when markets are doing well, products are doing very well. And when the cycle turns, there is nothing new to add then. So I think one approach that we prefer to take at times is we communicate a lot more about risk. Even today, very shortly, you'll see our campaign on airports, where we'll talk about, what were those periods of zero return for the 3 primary asset classes, equities, bonds, and gold. And if something like that were to happen, as an investor, are you ready for that? So it's important to, balance this and talk to our investors and build capabilities.
All right, very interesting, Kalpen, and that stand-up comedian part really got our interest. So Sonal and I are going to go look this up. It's also giving us ideas for our own show now. So thank you very much for joining us and taking us through this complete class on how you can really go about, picking a fund, how you can go about creating a portfolio allocation that works for you. Of course, there's no one-size-fits-all approach, but this helps us with a lot of the basics.
It does, and hopefully it, of course, helped our viewers as well. But with that, we'll take your leave on this edition of Mutual Fund Corner, but stay tuned for Closing Bell to take you through the last hour of trade.